the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession.
The July Fed meeting delivered one of its most pivotal moments in decades, not because of a rate change, but due to a rare split among policymakers. For the first time since 1993, two members of the Federal Open Market Committee broke ranks. One called for a rate cut, the other supported holding steady. This division signals that internal confidence in the Fed's current policy stance is starting to crack. The timing was critical, coming just before a disappointing jobs report that not only missed expectations for July but also saw major downward revisions to May and June, cutting a combined 168,000 jobs. This sharp labor market slowdown has reignited recession fears and dramatically shifted market expectations toward a Fed pivot. As of this weekend, futures markets are pricing in an 88% chance of a rate cut in September, including a 25% probability of a more aggressive 50 basis point move. With job growth softening, wage momentum fading, and geopolitical tensions, including new actions by President Trump on Russia, adding pressure, macro uncertainty is intensifying. The broader picture shows a fragile employment landscape combined with weakening economic indicators, prompting investors to brace for policy shifts and potential market volatility ahead. In her latest In the Know podcast, ARK Invest CEO Cathie Wood fully embraces the idea of an imminent rate cut, calling it the final trigger needed to unlock economic recovery. She believes a mix of lower interest rates, declining inflation, and rising productivity could fuel a strong rebound, particularly for crypto markets, which rely on liquidity and innovation. According to Wood, we may be moving from a rolling recession into a rolling recovery that accelerates through the 2026 election cycle. For investors in Bitcoin, Ethereum, and broader risk assets, this could mark the beginning of a new phase of aggressive growth. Cybercriminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
I'll start by summarizing that, this employment report is jarring investors because it was much weaker than expected, mostly because of downward revisions to previous months, significant downward revisions. And so fears of recession are starting to surface. And I just want to remind everyone that we have been using this phrase rolling recession for the last 3 years. And I think as we get into the chart, you'll see what I mean. Anticipating that we would get this last leg, especially with the uncertainties around trade and tariffs, tax policy, and regulation or deregulation when it would take place. A lot of those are clearing up right now, and one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were 2 dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. We do know that there's some rumblings today, not rumblings, I guess. President Trump on Truth Social said he was moving 2 nuclear submarines toward Russia because of some provocative statements, it seems, or that he and Medvedev, who's Putin's deputy, have been having words. So there's that going on. So geopolitical risk, we don't think that goes away, and we don't know what's going to happen with Russia and Ukraine. It's unbelievable that it's lasted 4 years so far. The other uncertainties are China and Mexico. Most trade tariffs have been decided as of today. But China and Mexico have, I think, roughly 90 days, 90-day reprieve. So that's an uncertainty. But as I said, the biggest one is the Fed going to move? We think it will move now, even though Chairman Powell sounded quite hawkish this week in his testimony. So with that, let me go through some of these charts and visit first. So we will start with fiscal policy. Now, what's very interesting is year to date, the deficit as a percent of GDP has shrunk from roughly 7.3% to 6.2%. And as we add up all of the tariffs now, they're annualizing, it looks like, at $450 billion per year. So that would take us to the X you see here. I think that's roughly a 4.7% deficit. So we know that's going to happen. And the green line is 3%, which is Treasury Secretary Bessent's objective for 2028, the end of President Trump's term. Well, the 4.7% assumes no growth, and we do think growth will be slow until some of the uncertainties I mentioned are out of the way, but will pick up momentum, and we would not be surprised by the end of 26 to see this metric, deficit as a percent of GDP, at 3%, so 2 years ahead of schedule. So the bond market should appreciate that. And I do think it will be a positive backdrop for equity investors as well.
Cathie Wood has long championed the idea of a rolling recession, where different sectors of the economy weaken at different times rather than collapsing all at once. Now, with job data softening, fiscal pressures easing, and rate cuts likely on the horizon, she believes we're entering the next phase, a rolling recovery. This won't be a sharp V-shaped rebound, but a steady resurgence fueled by innovation and favorable policy shift. A key signal, she says, is the surge in year-over-year productivity growth, even as GDP remains modest. Historically, such spikes mark the early stages of economic expansion. But this time, it's not just cyclical, it's structural. Breakthroughs in AI, robotics, energy storage, blockchain, and multi-omic sequencing are fundamentally reshaping business models, lowering costs, boosting margins, and creating entirely new markets. Wood forecasts productivity growth could exceed 5%, a level unseen in decades. That's a game changer. Higher productivity without matching wage or inflation pressures often means lower prices, rising profits, and more reinvestment into innovation, conditions ripe for growth stocks and especially crypto, which thrives on both liquidity and technological relevance.
On this slide, just to give you a sense of where GDP growth and productivity growth are now. This is on a year-over-year basis. They tend to be highly correlated. But you can see the real surges in productivity as measured by as depicted in the green line here. They tend to occur at the beginning of recoveries after recessions. Well, we've been in a rolling recession, and the fact that productivity has held up this well for this long is really saying something about underlying a secular change in productivity growth, and we think it's going a lot higher. We wouldn't be surprised to see 5% or more sustained for much longer than just at the beginning of the rolling recession and expansion. We think the new technologies evolving today, and we talk about them all the time, robotics, energy storage, AI, blockchain technology, and multi-omic sequencing in the life science space, are going to drive huge productivity gains. And we're looking forward to watching where those productivity gains land. Are they going to land in corporate margins? Are they going to land in compensation? Are they going to land in more spending on R&D? Or are they going to land in lower prices? And we think all of those are true. In some regions, some more true than others. For example, in China, given that they're trying to stimulate a consumer economy, they'll probably end up more in worker compensation than perhaps in the United States. In the United States, as the Fed tries to get inflation down, maybe lower prices. But we think all will see some impact. On the next page, you can see, just to illustrate a little bit of drama recently, it's somewhat hard to see, but in the green line there, you see a surge to a level that you've never seen before, just as you saw a drop to a level you'd never seen before. That is the trade impact, the impact of tariffs. The front loading drove the trade deficit up in the first quarter and took real GDP down by 0.5%. This last quarter, second quarter, the numbers just came out, that reversed. And trade actually added nearly 5 percentage points to real GDP growth, which is really saying something because real GDP growth was only 3%. A big part of the offset, or the difference there, was in inventories. Inventories made up a lot of that difference. But it is quite striking that we've had such a shock to the system. And the stock market is where it is, despite today's sell-off. And quite frankly, I'm I'm never happy to see the market going down, but I am happy not to see the market just going straight up. We've had some very big IPOs that seemed frothy, shall we say. Circle was a big one of those, and as you know, ARK was a big beneficiary. Figma was this week's version of that. We think the market, we'd much prefer to see the market climbing a wall of worry, which it has been doing around tariffs. That is a stronger, more durable bull market, and it broadens out. Very recently, there's been a little bit of narrowing, but we think if we're right on what's going to happen to the economy and inflation, that it will broaden out, as it has been benefiting innovation strategies like ours. Here is the drama we got today. The revisions to non-farm payrolls, they were extreme. We typically don't see this kind of revision except in a recession. We're in a rolling recession. I think this confirms it. I think many economists might take these numbers and start running with a longer recession scenario, where we do not believe that. And we do think the equity market will see through that after this wall of worry moved down today and maybe somewhat into next week. Looking through the report, many sectors were down. I think we're seeing the hit to federal government employees. Year to date, those are down now by 84,000. And I think we're facing another 150,000 by the end of September. So that means that 10% of government and federal government employees will have been laid off by the end of September. And of course, a lot of other jobs are tied to the government sector. So I think that's creating some uncertainty in the employee's mind in terms of jobs being there or ending.
Cathie Wood paints an optimistic picture of what's ahead. Falling interest rates, easing inflation, surging productivity, and a shift from a rolling recession to a rolling recovery, all driven by exponential technologies like AI and blockchain. Her thesis leans heavily on long-term innovation and deflationary trends, but it arguably overlooks short-term vulnerabilities like weakening consumer demand, persistent core inflation, and geopolitical uncertainty. That's where Raoul Pal's Everything Code provides a powerful counterpoint. Rather than focusing solely on rates or growth, Pal sees liquidity as the true engine behind asset prices. His argument: the higher interest rates remain, the more liquidity the system ultimately needs to sustain itself, especially in a world of mounting debt and rising interest costs. As he puts it, the higher rates go, the more liquidity must be injected, and the higher assets climb. That paradox is already playing out. Despite elevated rates, markets remain resilient, propped up by liquidity flows and global capital movements. If the Fed pivots even slightly, this latent liquidity could surge back into the system, boosting equities and crypto alike. Bitcoin and Ethereum thrive when liquidity and narrative align, and right now they have both. While Wood focuses on productivity and policy, and Pal on liquidity and debt dynamics, both point to the same conclusion: risk-on conditions are returning. The real question is, are you ready for the rally? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.